Yes, Naren, Chief Investment Officer, that is CIO with ICICI Prudential AMC, joins us live. Naren, fantastic to have you back on ET Now. Thank you for joining us. Naren, I guess depending on whom you're asking, you will get a different market opinion, because market internals and the opinion is split right in the middle. DIs are selling, but FIs are buying. IT stocks are making a comeback and bank stocks have started retreating. Everyone has a view on Fed and no one knows what Reserve Bank of India will do.
Yeah, that is true. I mean, see, markets were very straightforward the last time I appeared on the channel. In fact, 10-year had crossed 9.2%. So actually at that time I could mention that the market was at mouth-watering level in debt. So at that time when it is straightforward, it is as you markets are in panic. So, you know, when you are in extreme panic and extreme euphoria, to me actually the market call is very clear. But today we are somewhere in between. And that's why you have split opinions everywhere, and you don't know today whether the market. That's why we have a different take at ICICI Prudential, where we have created a fund called Volatility Advantage Plan. So that we find is very useful in this kind of markets, where actually you don't even know whether the market will go up in the near term or come down in the near term.
So tell us, Naren, how does one take advantage of the volatility? And more importantly, do you think, volatile or not, but the market is going to remain range bound, 5,800, 5,900 on the tops and 52 on the lower end?
See, actually, 52 to 58 is a long range, and, that kind of range is something which is still stressful for people if you give a range of 15%. I think our view has always been that till the elections are over in India, I think you're going to see a volatile phase. And in that volatility, what we have funds where you sell as the market goes up and buy as the market goes down, not taking a view on the market, because the moment you start taking views on the market, you're in confusion. So that kind of strategy is the kind of strategy which we think individuals will find very difficult to implement, and for funds which are having such a strategy, it's easy to implement, because we are not looking at whether if we sell at 5,800, we don't bother if the market goes to 5,900, because if it goes to 1,500, the model suggests you sell a little bit more, so we will sell a little bit more. So I think it is that kind of thing which we actually like at this point of time, because you have a complicated environment where growth has decelerated significantly, and you have an environment where short-term interest rates are high. I think it's easier to believe that the current short-term interest rates, where everything is in double digit, has to become single digit. I think that is a more easier call at this point of time than to believe that the market, equity market, will give you big returns.
Naren, the widespread view with the global money managers is that Fed will taper light and the accompanying commentary will be slightly dovish. But if we get hint of little bit of, more tightening from Fed, and if they are slightly more hawkish than what markets are betting on, do you think that could lead to some kind of a panic reaction in emerging markets, which already have rallied good solid 8 to 10% from the recent lows?
See, if you take panic reaction, yes, 2 to 3% or more kind of moves is possible in the market. On the negative, the commentary is hawkish. But what I find with the Western world is that actually they are now trained to have central banks which don't give any shocks. And they'll give shock. Of course, the fact that equity markets are close to all-time high in US does justify that they will not give too aggressive a commentary. But otherwise, if you look at the recent past, almost ahead of every Fed event, they have actually managed to create a consensus which is very close to what they want to deliver. So if you think about it, 3 months back or 2 months back, people weren't sure what would come out of this Fed policy. But now anyone says it's between $10 and $15 billion taper, with the bulk of the tapering happening in treasuries. I think this has become a complete consensus, and in recent times, central banks don't disappoint the markets in the Western world.
I distinctly remember last time when we interacted with you on this forum, tactically you were bullish on banks, and banks have done rather well. banks are up, or the bank Nifty is up 17-18% from the recent low. Private banks are up anywhere between 25 to 35%. Do you think best part of the banking rally is now over and all the good news or all the economic fundamentals are now in the price?
No, actually, I think for markets to deliver big returns from here, you need a set of conditions. You need much lower crude oil prices. You need a slightly better growth environment and much lower short-term interest rates. I think all these three, along with, if you see what the government has done, is that they managed to stabilize the currency. They're basically offloading dollars direct to oil companies for their imports, and they're getting a replenishment route through the NRI deposit facility. So I think they have managed to stabilize the currency pretty successfully. Now the point is that finally at the end of the day you need the other three. That is, you need growth to pick up, you need interest rates to come down, and you need a more benign environment. And that benign environment doesn't appear, barring a brilliant monsoon. It doesn't appear that growth is going to accelerate in the near term. It doesn't look like it. If I start thinking about what results will be in October, November, I think the results are not likely to look good. I think we've seen some part of it in the advanced tax numbers which have been reported in the press. So on the whole, we are in the volatile territory with no big return expectations from equity. The return expectations from equity is not very large from your side.
So Naren, what's the approach then for IT? How long is this steam going to last?
See, I think IT has a currency benefit and a near-term growth benefit over all the other sectors. I think as long as these two last, IT will do well. The day the currency benefit falls and the day the differential growth between IT and the remaining sectors come down, I think the large cap tech names, if you look at it on market cap basis, they are not at all cheap at this point of time. So they require both the benefits, both the currency benefit and the fact that the growth differential between them and the other sectors. So I wouldn't call IT a value sector. I would call IT a sector to invest in at this point of time because of the environment that we are in at this point of time.
What about autos? Couple of brokerages are turning positive, at least on names like Tata Motors. We've got a Moody's upgrade as well coming in for Jaguar and Land Rover.
Yeah, actually auto, no, we've been cautious in the sector now for more than 2 to 3 years because our belief has been that without a consumption slowdown, neither will inflation come down significantly nor will current account deficit come down significantly. What the government has done is they have actually concentrated the consumption slowdown only in gold, and they have created a brilliant consumption slowdown in gold imports. Now, actually, does consumption slow down in gold or only gold imports slow down? That's a confusing situation at this point of time. Our belief was it won't be just gold, but there will be a more broad-based consumption slowdown. But right now, if you look at the scenario very clearly, the government has managed to focus the consumption slowdown just on gold. Every week, you have newer and newer guidelines which make it very difficult for gold to be consumed. So they are focusing on gold. If they win and no other part of the economy requires a consumption slowdown, actually I think our call in auto will be going wrong there.
Naren, there are two popular themes in the market. One, bet on rupee depreciation beneficiaries, and B, bet on exporters which will benefit if global economy picks up. So how are you aligning your portfolios to benefit from both these themes? Because they are powerful themes and they are the obvious themes.
Now, as you're aware, we've been having this view for more than 2 years now, and our portfolios have always been overweight the exporters at the expense of the consumption sectors. And we've also been overweight stocks and sectors which are like linked to dollar, like for example companies which have a global footprint, companies which are like textile industry or those kind of sectors. We've always had this view. The point is, if you look at the way the market valuation is at that point of time, the ones which are very, very obvious beneficiaries of exports, like the large cap tech names, they're valued for this particular problem at this point of time. But what I've seen from the consumer experiences, you can actually have a overshoot in these kind of circumstances. We have not reached that overshoot phase yet, but we've reached the fair value zone in all these sectors, given the benefit of currency. But beyond sectors like tech and a few large cap healthcare names, I think the rest of the market is still not believing that exports is such a big story. What we think of is we could go back to the 90s era, where you had actually sectors like textile, auto ancillary, all these kind of sectors, engineering goods, all these sectors were also very big beneficiaries of the export boom then, and those kind of sectors are still pretty cheap at this point of time. So we are still focused on them at the expense of the consumer sectors.
Naren, pharma is getting extremely stock specific. You've got Ranbaxy on one hand, and the other hand, stocks like Cipla Sun Pharma making fresh highs on a daily basis consistently. Do you like anything?
See, actually what I've learnt in pharma is that I have a colleague who looks at pharma stocks in particular, and what he has to do is become very, very important to the company, because if you go wrong on the choice of the stock, your entire alpha in the sector goes away. And we have actually had a very good experience, maybe due to the work that he has done. So I would say that, the stock-specific research is very useful to us in that sector, and we have been benefited significantly by that. But, we have to remember that no analyst can correctly predict what will happen in FDA in a particular company. So that is what I call a known unknown of the sector at this point of time.
Naren, whereas your house view is bearish or cautious on financials, financials still have a large weightage on the Nifty. You cannot go zero on them. So what do you own within the financial space? Do you own private banks? Do you own PSU banks? Or you are sticking to NBFCs and just keeping it safe and simple?
No, actually, we've always had a much, much bigger weightage in private sector banks. We do have some weightages in public sector banks in the last 1 year, because the sector had really underperformed from 2010 to 2012. So we continue to have that view. I think all that is required at this point of time for the sector to do very well is growth to come back. But otherwise, if you wanted to look at it 1 month back, it was looking net interest margins were going down, NPLs were going up, and growth was also going down. So the combination was looking very adverse a month back. Right now, the attitude seems to be that the government will actually support some way to ensure that the net interest margins are supported. They're talking about refinance schemes, etc., etc. So I think the outlook for the sector is improving. If growth comes back, I think the NPL worries will be a lot lesser today than what it is today. See, today we are in a strange environment that in many of the power utilities also, they are backing off, and actually power deficit is at possibly one of its lowest in the last 5-6 years. The reason being that there is a very low growth in the economy, and therefore with the growth, power utilities will start consuming power, and then many of these power related NPLs people are worried about will actually become much smaller worry than what it is today.
Naren, how are you approaching metals now? It's had a great last series. Is that trade over?
See, actually, we were one of the few investors in the market who were very, very bullish on metals, and actually we gained a lot in this rally. See, right now still the sector is dirt cheap, but as we have seen in the past, what happens locally is not relevant at all. What happens in China is most relevant. If you look at it, it's one of the few sectors in the economy which are playing the quasi-export theme also. Because if you see, they are big beneficiaries of this big dollar move, and therefore we continue to have a big overweight position in this sector. Because I think unlike the large cap tech and pharma names, actually the metal names have not had any benefit of the currency trade. And many of those companies in the next 6 months to 9 months is going to see the benefit of the currency trade, which is why I think we are significantly overweight. Having said that, we have seen that if China again sneezes or gets a cold or gets a fever, it's a sector which actually falls off very sharply in India, irrespective of what happens to the earnings of many of these companies in India.
Naren, final question. So in times of adversity, where is the big opportunity?
Actually, the adversity is there, but the market valuation is not dirt cheap in the market as a whole. So we do find market valuations cheap in select mid caps, some energy names, some material names, etc., etc. So I think our market view is right now volatility. So yes, you have an adverse environment, but we are not a believer at this point of time that big returns in equity can come very easily. We believe that market returns will be okay, and which is why we recommend defensive strategies like our volatility advantage plan. We also believe that the short-term interest rate space is very interesting, because whenever you get double-digit returns on most short-term products, you've never gone wrong in India by investing at this space. So these are the two spaces we have actually liked at this point of time for investors, because we believe that, we are not at this point of time, if you were to ask me, will you get another 10% rally from here in the near term, or some number like that, it doesn't look at this point of time possible. That is what we've been believing, but you've seen how markets behave. 5200 to 5800 happened in a jiffy, and actually all the bears have actually had to run home. Luckily, we have mutual fund investors who have long-term money. So we were people who gained in this entire rally, but a lot of the other long, short kind of funds which exist from outside India, I'm sure they would have lost a lot of money in the last 1 month.
Naren, really good chatting with you. Appreciate you taking the time out and speaking with us today.